Hello, I'm Alex Davies, founder of Wealth Club, and today I'm with Shane Galway of Guinness Ventures to talk about the newly launched Guinness VCT. Firstly, Shane, tell me about Guinness Ventures and also give me some information about your own background.
Certainly. So Guinness Ventures is a part of Guinness Asset Management, which was launched in 2003. And across Guinness Asset Management, we have approximately 4.5 billion under management. We've got 60 employees. We're based in Westminster in London. And I've set up the Ventures arm, Guinness Ventures, in 2010. And we've been investing in growth companies since then across a range of sectors, including technology, healthcare, food and drink and leisure, and retail and education.
So, Shane, you're launching a new VCT. Why?
Well, Alex, we've got a great investment team at Guinness Ventures. We have been investing in growth companies since 2010, and we've seen we like to offer that to people within a VCT wrapper to access to these great companies that we see through our pipeline of great investments.
And what sort of companies will be looking to target?
Well, similar to our EIS, and within our EIS, we've targeted growth companies that are at scale-up stage. So these are companies that turn over at least $1 million of revenue and are looking to grow. We invested sort of between 1 and 5 million into these businesses, and we filter for businesses that are already established and have proved up their technology or their service or their product, and therefore they're at a stage where they're to some extent de-risked. And we tend to avoid the very early stage businesses, seed investment, which are the startups.
And do you want to tell me about recent investments you've made through EIS, because they're going to be very similar, I understand, to what you're going to do in the VCT?
Absolutely. And so these businesses, so we invest across a range of sectors, and that's one of our approach to ensure that we get a balanced portfolio of different sectors. And so to give you a couple of different examples of recent investments, Biblu is one. It's a business that has digitalized university textbooks and provides them to universities around the UK and increasingly the USA. And another growth business that we've invested in is Neighbourly. And Neighbourly has clients including many of the larger supermarkets and helps them with their ESG, their environmental, social and governance policies, and meeting those. It helps them with giving time and money and products to charities. So again, these are businesses that have demonstrated their market and are scaling rapidly, and we provide them with capital and all sorts of other assistance, including sort of helping them enter new markets, helping them with recruitment and building out the management teams.
How important are the management teams?
Management teams are key to growth companies, and I think we look for management teams that have experience, although often we see management teams with gaps, and we can help them fill those gaps through recruitment. We like management teams with complementary skills. You wouldn't necessarily start a restaurant with 3 chefs, so having complementary skill sets is a good indicator of a management team, and a clear vision.
And what about sort of some of the more established companies you've got in your EIS portfolio? How are they doing? Can you talk to me about them?
Sure. So one of the investments we've made is Saracare, which we invested in initially 4 years ago. Sarah has grown considerably. When we invested, it turned over about 4 million. It provides carers into the home. And Saracare has grown to revenue run rate of nearly 200 million. Oh. It has 10,000 carers on its books. And one of its key attributes is helping the NHS get patients out of hospital beds and into care in their homes. They've also gathered a lot of data on patients. They're able to use that to help reduce hospitalizations of patients in their homes. Another business that's grown very strongly over the last few years is Gravity, which started out with trampoline parks and have grown to have 17 trampoline parks around the country, and last year developed the big box leisure concept, where they've turned a 3-story Debenhams store into a electric go-karting track, bowling, darts and golf.
How's the current economic environment affecting how you invest and also your portfolio companies?
I think in terms of affecting how we invest, we definitely look at how companies are set up to weather a recession and also inflation. And I think having a flexible cost base is important, and having a robust growth plan that can perform through different cycles of the economy is also very important. In terms of our existing portfolio, we've helped them prepare for tougher economic environments. And again, that's something that we work closely with investee companies to ensure that they are prepared and have sufficient runway to help them deliver on their business plans.
As everyone knows, VCTs, EIS, they're risky, and it's going to be a new VCT. What would you expect a typical failure rate to be in a portfolio?
Well, we've made over 40 investments with our EIS, and we have a failure rate of 5 companies. It is a natural part of investing in high growth businesses. I think our failure rate is reduced by focusing on businesses that are already established. The failure rate between seed investment and scale up Series A investment, which is where we come in, is about 50%. So by going in at a later stage, we tend to avoid those riskier businesses. But it is a part of growth company investing, so we expect a percentage of the portfolio to fail.
Clearly, the VCT is brand new, but can you tell us about some of the exits you've had from your EIS portfolio?
Certainly. So recent exits we've had include Seller & Co. and ContentCal, which was bought by Adobe for over 100 million, returning, giving our investors a 5 times return in under a 12-month period. Other exits we've had include Pasta Evangelis, which was bought by Barilla, the world's largest pasta maker, and also Jones Foods, where Ocado took a majority stake in the business. Jones Foods grows leafy greens in hydroponic environments, so in enclosed environments under LED lights. We made a partial exit from Sarah Care, returning approximately 4 million to our investors. Another partial exit from MWS Technology, which is a software business that provides software to the apprentice training industry.
That all sounds very encouraging. And how's the portfolio performing at the moment?
Portfolio has been performing strongly, and I think led by some standout businesses. And we've had 5 companies in the FTSE 1000 fastest growing businesses that was published last year. Those include others such as Doctify, which provides a rating for private doctors and dentists. Thriver, that provides blood testing services. Sarah Care, that I'd already mentioned.
And what about dividends? You're a new VCT. When do you plan to start paying dividends, and what will your target be?
We're targeting 5% of net asset value, and we're targeting first dividend from 2026.
Perfect. And finally, why should investors consider your new VCT this year for their investment?
Well, first of all, it's a great time in the investment cycle to be launching a new VCT and making investments now. I think one of the key points is valuations are at a really interesting point, and making new investments at this point of the cycle should be very attractive for investors. I think Guinness provides an experienced team with a proven track record of making and exiting first-rate businesses.
Shane Galway, Guinness Ventures, thank you very much.
Thank you, Alex.